The problem with most dividend stocks is they just don't pay enough to live on. Alright, first dividend check. What can I get for 37 cents? In this video, I'll reveal 7 income investments that yield on average 14%, more than 10 times the average yield on dividend stocks. I'll show you option strategies to boost your income, how to set each up, and how to invest $10,000 for massive cash flow. Hey Bowtie Nation, Joseph Hogue here, solving one of the biggest problems in dividend stocks, those miserly payouts. For example, the average dividend yield on the market is just 1.3%. That's a dividend of just $13 a year on every 1,000 invested. Even the supposedly high dividend stocks and funds aren't that much better. The Vanguard High Dividend Yield ETF pays just 2.8% a year. Even on a $10,000 investment, that's just $23 a month in dividends, which is about enough to fill up your gas tank if you drive a scooter. But the 7 income investments I'll show you next average 14% dividend yields, more than 10 times the market average. A combination of dividend stocks, income investments, and option strategies for the highest possible cash flow. We're getting started, but before we do, I've got to send that special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of the community yet, just click that little red subscribe button. It's free and you'll never miss an episode. On a side note here, you can find all these stocks on the Webull app. Use the link I'll leave in the description below and get 3 free stocks up to $3,300 when you open and fund a new account. Webull is also running a special promotion. Get $5 in crypto rewards with your first cryptocurrency trade of $1 or more. Now, free is always great, but what I really like about the app is the stock simulator that allows me to test out ideas and track stocks before investing my own money. First on our list, USA Compression Partners, ticker USAC, with its 13.3% dividend yield. USAC does one thing, and it does it very well. The company provides compression services for natural gas producers, allowing the gas to be moved through pipelines. Focusing on just the small part of the midstream component makes USAC the go-to for services and removes a lot of the reliance on natural gas prices. You see that volatility in natural gas prices here in the red line, jumping up and down. But look at the green and blue bars, the adjusted earnings for the company. USAC has been able to drive stable and growing earnings even in the worst times for nat gas because it's built that business based on demand, not on price. And demand for natural gas is expected to jump 28% over the next 30 years, with U.S. exports rising more than 5-fold. The company has paid out a consistent dividend of 52.5 cents per share quarterly since 2015 and returned over $1 billion to investors since the IPO. A $10,000 investment here would mean over $1,300 a year. Not the highest dividend payout on our list by far, but a solid check and more than 10 times the market average. Orchard Island Capital, ticker ORC, is a mortgage real estate investment trust, or MREIT, paying a 16.8% dividend yield. Now, unlike other REITs that own the properties themselves, MREITs borrow on short-term rates to buy those long-term mortgages and are going to use leverage of 2 or 3 times their capital to buy more mortgages. So then one of the most important things about mortgage REITs that you need to follow is what's called the shape of the yield curve. That's this left chart here showing the interest rates on treasuries from 3 months to 30-year rates. Now that's important because it's directly related to the profitability for these MREITs, being able to borrow at that near zero interest rates and then buy loans making 2.5% or more a year. And now this dynamic could be a tough one for MREITs as the Fed starts raising those short-term rates. And if investors get worried about the economy and those long-term rates don't rise as much, mortgage REITs could lose money, but I think a lot of that fear is already baked into the stock price. Shares are down 19% since mid-November and really attractively valued at this point. So the dividend payment on this one is going to be more volatile than a lot of the stocks because the company pays out most of that cash flow and that cash flow rises and falls along with interest rates. If you look at the bottom chart though, that's the dividend yield on ORC in blue against an average MREIT yield in red, including other popular stocks like AG&C and Annaly. Orchid has constantly paid a higher dividend yield and been able to maintain that around 15% for most of the last 8 years. Best yet, this one is a monthly dividend stock, so you get that cash flow every single month. On a $10,000 investment, you're making nearly $1,700 in dividends each year. We've still got 5 more dividend investments to highlight, including one that pays you over 20% a year, but understand getting that insane cash flow also means accepting more risk. These aren't like investing in Coca-Cola and never worrying about the money. These are high-yield, high-risk income investments, so be ready to hold through some of those tough times. This next one is no less controversial. Shares of Icon Enterprises, ticker IEP, and its 14.6% dividend yield. Now, IEP is the holding company for Carl Icahn's investments and his businesses in energy, industrials, auto parts, real estate, and pharmaceuticals. This one owns or uses controlling shares in some very strong companies like Pep Boys, CVR Energy, and Vivus. And what's really exciting about this, though, is the ability to invest alongside Carl Icahn, the original corporate raider of the 80s, which personally, I like that term much better than what investors are calling it now as an activist investor. Icahn's history is one of the most interesting stories in investing, starting with his first takeover attempt of Tappan in 1978, forcing the sale of the company to Electrolux for a $2.7 million profit. Even his unsuccessful takeovers, like the 86 bid for US Steel, make money. He dropped his bid in 1991, making $200 million on a $1 billion investment. Now, the usual strategy here is Icahn buys up the stock or the company's debt for a controlling share. He then pushes the board of directors to change management, spin off assets, or outright sell the company. The ability to move billions of dollars around quickly means company directors have to take him seriously, and even when he's not able to force that change, a lot of times the company's just going to pay him a premium on his investments to make him go away. It is a win-win strategy Icahn has perfected to make billions of dollars. The shares pay a 14.6% dividend, turning a $10,000 investment into $1,400 in cash flow, and investors have doubled their money over the last 5 years with price returns and the dividends. Now, I wanted to include this next one, the ProShares Listed Private Equity ETF, ticker PEX, for a couple of reasons. The PEX is a fund holding private equity companies. Alternative investment funds usually open only to the wealthy that make investments in private companies without shares available, or they buy out public companies and take them private. So it's a great way for regular investors to get access to this type of investment class that most people just don't know about. Since it's a fund, though, it's also more diversified and less risky than some of the individual stocks on the list. Adding ETFs like this one can help you smooth out those ups and downs of the riskier plays and still collect that solid cash flow. The fund is well diversified across other private equity companies and even internationally, giving you some exposure to foreign stocks and businesses. That 9.3% dividend is lower than the others on the list, but again comes with less risk and still 7 times higher than the yield on the market. Next is a great way to use options for cash flow on the Bitcoin ETF, ticker BITO, and a strategy I have over $28,000 invested in a retirement account. And now this actually brings up a really important reminder that your highest income investments, they need to be in tax-advantaged retirement accounts. And unless you're living off those dividends right now, you want to invest these into your retirement account so you don't have to pay taxes on the cash flow every single year. Otherwise, that annual tax on your dividends and your income is really going to bite into these. I've got an Options 101 video that I'll link to in the description below, along with my 5 favorite strategies. But as a quick refresher, options are just a separate investment you can make that gives you the right to buy or sell shares of a stock for a set price over a certain time period. Buying a call option, for example, gives you the right to buy a share of stock at a set price. I pay a fee, or what's called a premium, for the right to lock in that share price over a month, several months, or even as long as a year. What we'll be doing here is called a covered call strategy. We'll be buying the stock and at the same time selling a call option. And this gives another investor the right to buy those shares from us at that set price in exchange for a cash payment right now. And this is not only a great cash flow strategy, but a way to lower your risk on the stocks that you own. You see here, you can buy the ProShares Bitcoin Strategy ETF, that's ticker BITO, for $23.58 each. And then I'll go into the options available and select the options expiring next January. Now you can make this a monthly cash flow by picking monthly options, but I like to measure these on an annual basis. And here you see where it says last price, the price for each of these options. For example, we see that the call options for BITO at $25 a share are priced at $5.55 each. Now this is going to be that lower risk income strategy, so I want to pick an option that is closer to the current price for that higher income. And if you want more potential return here, you would then want to pick an option further away from the price, which would mean lower income but a higher upside. But then if we sell these call options at that $25 strike price, then we collect $5.55 each. Now remember, with this, I'm saying give me $5.55 now, and I'll sell you my shares of this fund for $25 next January. So I'm collecting a 23.5% cash return by selling this option. One of the best parts, though, about this strategy is it also lowers your risk. If the price falls or just stays below that $25 strike price through next January, I keep the shares as well as that cash premium. The $5.55 collected effectively lowers what I paid on the shares to just $18 each, which is a huge downside protection. Even if the stock does run higher, though, closing above that $25 strike price where the other investor uses that option and buys my shares, I still keep that 23% return on the cash collected plus get a 6% return on the price to that $25 each. And now the reason why this works so well and creates so much income with this Bitcoin fund is because of that volatility in crypto. Because cryptocurrency prices fluctuate so much and these funds follow those prices, then the price for the options have to adjust for that and are much higher than you get with other options like stocks on Apple or Coca-Cola. That means on a $10,000 investment, your annual payout could be more than $2,300 for the highest cash flow yet. Our next dividend stock is that same covered call strategy, but letting a fund manager do it for you with the Global X NASDAQ 100, ticker QYLD, and its 11.8% dividend yield. I actually did a review of this one and 4 other high-income funds in a previous video that I'll link to in the description below. The QYLD uses a covered call strategy on the NASDAQ 100 index. That's the largest 100 companies in the tech-heavy NASDAQ. So what it's doing here, it's buying those 100 stocks in this index, mostly large technology companies, and then it's selling call options against those. That covered call option strategy helps the fund by doing 2 things. And first, by collecting a premium selling those call options to another investor, the fund generates immense cash flow. In this case, most of those tech stocks don't pay dividends, so it's a great way to turn a portfolio of tech stocks into an income-producing investment. The strategy also does something else, though. It also gives the fund exposure to that high-return NASDAQ, the fast-growing tech stocks, but lowers the risk a little bit. You see, by selling those call options, the other investor is taking some of that risk that the stock prices fall. So the fund not only generates cash, but is also going to be less volatile than just owning the NASDAQ 100 tech stocks outright. Now, looking at the stocks in the fund, it's a who's who of big tech companies with more than $500 million in shares of Apple alone, along with Amazon and Microsoft. But if you scroll down, you see not all of these are tech stocks. You've also got some shares of Comcast and Pepsi as well because they're in that NASDAQ 100 index. Now, there is something you don't see here, though. You can see all the fund holdings on its website, and that's the covered call strategy it's using. So what is it selling to offset some of that risk and generate cash? And so digging into this, we see that the fund has sold call options against the NASDAQ 100 fund worth about $351,000 and covering 3,200 shares. This is interesting because it shows the exact strategy here. So the fund holds about 320,000 shares of the NASDAQ 100 in its net asset value of those stocks, but then it sells calls covering about 1% a month. So it sold call options for 3,200 shares on the index. And that's generating some cash flow, though it doesn't limit the upside too much because it's only 1% of the fund. Now, pros of this QYLD ETF are that it's big and liquid. You'll always be able to buy and sell shares of the fund quickly because the daily volume is so high. It's got a strong management team, and it's a good balance between that high dividend and return. The downside to the fund, though, may be that it's so heavy in tech stocks, which calling that a downside really depends on you. It is tech heavy, though, and the limited covered call strategy isn't going to protect the fund from a crash in those tech stocks. For example, when tech stocks in the NASDAQ fell 8.6% in the 3 weeks late February of last year, shares of the QYLD still fell 7.2% over that period. So it really only protected you from about 1% of losses. Another downside of the fund is that in a rising market, the fund will underperform the stocks. That's because as those stock prices rise, the investor buying those call options is going to exercise them, buying the shares away from you at that lower price. You can see here that the QYLD in red, with its 3% loss last year, underperformed the 12% return on shares in the NASDAQ. It's just the trade-off that you accept in exchange for that dividend yield and lower volatility, but it's still paying out nearly $1,200 on that $10,000 investment, which is hard to argue with. We've got another fund here, one I own more than $18,000 worth in the Alerian MLP ETF. That's AMLP, and it's 7.75% dividend. The fund holds shares of 15 companies in the midstream segment of the energy market, the companies in transportation, processing, and storage. Now, these are strong cash flow plays because the companies get paid on that volume rather than the oil prices and pass most of their profits on to investors. As a fund, it's diversified across every step in that midstream segment and holds the best companies in the group like Energy Transfer and DCP Midstream. Best of all, though, it's a way to invest in these companies without that annoying K-1 tax form each year. Now, the dividend is volatile on this one, and it's the lowest yield in the group, but still pays nearly $800 cash flow on that $10,000 investment. That's almost 6 times the market average and exposure to an industry that I think could do really well over the next few years. Click on the video to the right for the 11 highest paying dividend stocks in each and every sector. 11 dividend stocks for a diversified cash flow portfolio. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.